You're with us here on a fresh new edition of Trading Hour. I'm Prashant. With me, my colleagues Mangalam Malu and Sonal Bhutra. Guys, hi. Good morning.
Good morning.
I mean, the market's doing just fine, right? For a not a Friday, a Thursday.
It feels like a Friday, though.
Feels like a Friday. I mean, we've been up and down by, 40, 50 odd points. That's the range of the move that we've seen from the beginning. Up 150, down 40, down, back up 150, down 40. I mean, at least 3 or 4 times now. But the trend is slightly one of profit-taking. As you can see on your screen, lower highs through the course of the day. And I'm talking about intraday moves, but that's what we have. 16,967. The bounce was of course started in the US and it spread across in Asia. It's showing up here in India as well. The big debate out there is whether this is a very temporary, momentary bounce and the larger trend is still down. I, for one, would kind of tend to agree with that. But temporary bounces can also be large. I mean, relatively large. Can they be tradable, though? That is a question that you need to ask and answer yourself. I mean, each to his own. That's where we find ourselves at. Guys, hi.
Hi. So, I was just looking at two things. So the first data point is the outperformance that we're seeing of the mid-cap index. Usually that happens when the larger part of the street believes that maybe the index is fine for now. And the second part is that it is the expiry day today. And there are two options which are the most active. It's the 17,000 call and the 16,900 put. So put writers of the 16,900 strike believe that maybe 16,850 to 870 would be a strong support. Whereas writers of the 17,000 call believe that maybe 17,030, 17,050 would be a bit of a resistance zone. And that's exactly, the range in which we've meandered around through the first couple of hours of trade. Let's see what happens in the second half.
Oh, yes, that's because it's the expiry day, as you mentioned. So that will be the big talking point today as well and will determine the market moves. Mangalam did say that the mid-cap index is doing well. And I have to point at the specialty chemical space because that is the one buzzing in how we have a lot of stocks in focus there. Kimcon Specialty, we have Tata Chemicals, SRF, all of them buzzing on the upside. And we will cover that in detail during the course of the show. And we will discuss more market moves as well. But for now, let's do one thing. Let us invite the first guest on Trading Hour today. We are joined by Rohit Srivastava, who is the founder and strategist at IndiaCharts.com to discuss everything about the markets and technicals as well. Rohit, good morning. Thanks a lot for joining us. Well, you're joining us from Europe, I believe, and you're on a vacation. So I just wanted to understand first. By the way, that's quite a holiday look that you're in. So looking great. But
he's celebrating his 50th birthday in Switzerland.
So. Okay,
that's quite a way to celebrate. But I don't know, maybe joining CNBC-TV18 on the 50th birthday.
So we are the ones who are benefiting from his 50th birthday in Switzerland for sure. But Rohit, wishing you a very happy birthday from the entire team.
Shouldn't have revealed the age.
Yes, I think so.
Rohit, sorry about that. I meant 30, not 50.
Okay. So hope you're having a great holiday, and while you're doing that, you joined us here to discuss market technicals and a lot more. So thank you for that. I just wanted to understand whatever is happening in the global markets. You are in the heart of Europe as well. We saw a lot of action that's happening out there. What is the outlook for Indian markets as per you?
Yeah, thanks for having me. It's like 7 a.m. Here, so huge time difference. But what I'm seeing really, we are getting one of the first small bounces, a lot to do with news around UK. But I'm not sure this will be a tradable rally yet. If I purely look at the Nifty, which is the core question, we have seen what's been like a falling knife for quite a while. If we do bounce up, I think 100, 200 points or 300 max may be the case. I think there'll be one more round of selling, which might finally hit somewhere between 16,800, 16,700, which is close to the weekly averages, which are there. The 20, 40 week averages are clustered around that range. And I think that's where you'll probably get the first tradable bounce, which Prashant, you were just talking about. So I don't think we are there yet for a tradable bounce. Though, if I simply look at US markets, the dollar bond and all their sentiment indicators, which is we follow something known as the daily sentiment index, which is the global survey. And that has actually hit, single digits, like only 5% or 7% people being bullish on a couple of those indices, which sort of creates a place where, you start hoping for a bounce back that is more meaningful. But we are still not getting it. So, this is what happens that when you get into a severe part of a bear market, oversold readings do not work. And therefore, judging that you're past that point simply on a one-day bounce is tough. But we may be getting there, but I think not yet. So putting that in perspective, I think Indian market specifically will have one more round of selling after a small bounce before we get a tradable rally, which we can actually, sit on for a couple of days. So that should be probably by sometime next week.
We'll have one more sell-off. The way you put it, Rohit, that's the last one? That will be the last one?
For this particular structure, so, I have been calling this a bear market since last year, which means since October of last year, we're saying this is a bear market, or even if we take it from April. And typically, bear markets in India last for around, 18 to 21 months or so. And so if I take that from the October high, it takes us somewhere to March 2023. So that's sort of putting a timeline. What we are looking for in this fall, and why I'm saying one more sell-off is, from a pure technical perspective, we look for something known as a five-wave decline. What that does is it gives us structure and comfort in being able to make forecasts going forward. So far, this fall from the high that we made close to 18,100 is three waves. This is the third wave going on. This bounce we are seeing today, maybe a fourth, and then we get a fifth, which is what I'm saying is the final sell-off. Then we get a tradable rally. But that tradable rally might still be a bear market rally. It may retrace 50-60% of the sell-off, and then that we could be due for another round of selling. That is what we are thinking. And so we are not completely saying that this correction would end at 16,800, 700. It would be one leg of the decline that we have started that will complete there, but it won't be the end of the bear market.
And what sectors are you particularly bullish on, and which are the ones to avoid?
So my sense, if you really study the last 8 to 9 months, is that we have seen each of the sectors in the market top out one at a time. If you look at the small cap index, it made its peak and along with IT in January. The metals, oil and gas made their peaks in April. We've seen the auto, power, and I think energy-related companies hit on capital goods. These indices hit new highs in the last rally into August. And so I think each of these sectors are sort of peaking through. My main point is that this might be a phase where almost everything goes down. So the only way, if we say that certain sectors are strong, it will simply be relative performance. Okay, can something fall less? The two sectors that come to mind, which have also been strong recently, is one is defense. For some reason, that's been getting more order flows and interest. And so maybe that's one area where interest will remain, so the correction could be smaller. The other one, which has been in decline for longer than most, and which was one of the peak performers of the post-COVID initial rally, is the pharma sector, which has been really down. So if there may be some hope that as a bear market grinds along, pharma stocks get a bid as money moves, from some sectors to defense. And so I'm not even looking at FMCG. I think between FMCG and pharma, I would probably prefer pharma as a defense. So these, I think, would be two sectors of interest on any decline.
Okay, so pharma is one of the preferred sectors as per you. What about IT, Rohit? Because that particular sector has been under a lot of pressure. Last couple of days there was some buying, but do you think there will be some stable signs we'll see for this one?
I seriously doubt it. IT and exporting sectors are likely to take the pain from what is happening around the world, and specifically US. So because most of the business comes from US and Europe, and US is clearly so far no change in its stance and path, which means earnings will continue to decline over the next 6 to 9 months based on the forecast that I'm reading. And if that is true, it has the most direct impact on the IT sector. And the IT sector also tends to correlate a lot with the NASDAQ. So I doubt you'll get anything meaningful there till you get a meaningful reversal in US equities.
By the way, Rohit, how's shopping going? What's the franc rupee rate? Has it done? Has it moved in your favor or against you?
Well, not much of a move since I came here. I think most of the move happened before the Fed stepped in. So it's fine. I think. See, costs. I mean, Switzerland is an expensive place. If I simply have to put it at that, so that doesn't really change. But it's been raining here, so not really been able to check on shopping.
That's why you're talking to us, huh? Stuck in a hotel room.
He's woken up at 7 on a holiday. That's something.
No, that's no. I mean, so come back and do the shopping. We need the shopping here, Rohit. Just a bit of global markets, though, right? I mean, what happened yesterday? I don't know if you were watching. You were traveling, so maybe not that closely. It felt markets are starting to feel, especially bond markets, because of UK, very fragile, very large moves. Which are not supposed to happen. They happen very rarely, and because they are so rare and they're so large. The tendency is to try to say, well, it's all coming undone, and what's happening in UK next will happen somewhere else, and it's the tendency to leap to that kind of conclusion is there. How would you describe what you've seen over the last couple of days, especially in the UK?
So my first thought on UK is that we've already seen, for example, Japan stick to its policy of keeping rates low and not really moving anything. We saw Europe do it for a pretty long time. They didn't really want to raise rates. And even as they're raising rates, they do have a bond buying program in the background to keep liquidity high. So they really don't want liquidity to tighten up. This is sort of what I think even China to some extent has done. They've started cutting rates. The UK is suddenly backing off from what they want to do. How does it really help the dollar situation? That is the mute question. I mean, you can look at it that the large part of the dollar's rise is the weakness of the other currencies. And if the dollar remains relatively strong to other currencies, and the dollar is the main borrowing currency for the world, you have external debt outside the US of almost $13 trillion outstanding, then it really hurts other parts of the world. So how does the pounds, attempt to weaken? Because finally, that's what they would, what they end up doing if they end up buying bonds. They actually weakening their currency further. How does that really help the situation apart from stabilizing the bond market in terms of the value of the currency? So I'm a little confused there, and so we would only end up thinking that the dollar bull market remains strong. Apart from a short-term pullback in the dollar, you probably see it strengthen again, which will probably not go down with various asset classes over time. And that's, I think, the end result of the thought process.
Okay, everything weakening elsewhere, strengthen the dollar. Just one last question briefly, Rohit. What's your forecast for the dollar rupee from here?
So I'm looking at 85, 87 as the initial move in this current swing that we are really seeing. I think we'll probably see it stop somewhere there and pause. It may not be the final high, but right now in this current move, going to 85 to 87.
All right, take your point, Rohit. Thank you so much for joining in, and once again wish you a very happy birthday from all of us here at CNBC-TV18. We take a short break, come back, we discuss what's buzzing in the commodity space. Manisha Gupta joins in. Welcome back. Apart from the equity market, it's also the commodity space which is buzzing around today. So let's talk about MCX. Manisha, what are the concerns around service contract with 63 moons expiring?
Oh, well, yes, thank you for that. We have seen Multi-Commodity Exchange of India, or MCX, the stocks see a constant decline. If you look at the prices itself, it has declined by 5% on a week-on-week basis. It's 10% down on month. And if you look at this year until now, we have seen 25% of a decline coming in for that contract. And that is, as you rightly said, there are concerns about the service contract, the expiry with 63 moons. There is a UBS report, which I'm going to quote because we did speak to MCX and we still are awaiting a response from them. But UBS says that the source code for the existing products has stabilized over the years, and also it will not require a change. So the current platform will just about continue. UBS also says that the change in code is required only when the situation is very different or during major events. The last couple of times that we have seen a code change has happened only once during the implementation of peak margin regulations. That was in 2021. And before that, it was when the crude oil prices had hit a negative. That was in 2020. Apart from that, in all of these years, there has been no code change that has been required. So that is one concern put away by UBS. UBS also says that MCX has notified all of its stakeholders and regulator as well about this transition. Also, there have been some technical glitches which are being worked on. It is work on progress right now. And apart from that, the testing on historic and real time will be done as we go towards the transition. The transition, or TCS as a new platform, only comes into being in the third quarter of 2023. So there is still some time and a lot of work will be done during that time as well. UBS report also suggests that the transition will also continue to decline or cut off the kind of software support price that MCX pays. So that also would be positive for their balance sheet there. So a lot of lookout onto this one right now. UBS also has put out or continued or extended a buy in case of MCX with 1900 as a target going forward.
All right, Manisha, thank you so much for joining us. That is the update coming in from the commodity space. But for now, we'll slip into a short break. When we return, we'll discuss market technicals with Rahul Mohinder of Virat, and we'll discuss his top trading bets. Hi, welcome back. Well, the stock on our radar is Vodafone Idea. Yesterday, we told you that the Indus Towers board met earlier this week and some of its directors have flagged concerns over mounting dues from Vodafone Idea. How will VI shareholders be impacted by this move? We have market expert Prakash Devan joining in to discuss more. Prakash, good morning. Thanks a lot for joining us. Well, that's the first question, right? What does this warning from Indus Towers to VI spell? What does it really mean?
Good morning, Sonal. So, essentially, I think this is almost like sounding a death knell to the company. The company is already struggling. We've not seen any kind of a respite in terms of the capitalization, which has been talked about or anticipated for almost 1.5 years now. And in the context of the 5G rollout, which is going to be capital intensive, I really don't understand how this is going to happen. There is a very clear diffidence from the promoters of the company to put in more capital. And if that doesn't happen, it's just going to be difficult for the company to be able to run smoothly and play that role of a third respectable incumbent in this telecom race. So it's definitely an uphill task. It's difficult for them to justify not paying these kind of dues to a company that itself is in a very, very aggressive capex and growth phase. So I think it's kind of difficult times for not only Vodafone but for the shareholders. They need to be a bit watchful given the kind of grave concerns that are impacting the business, the running of the business itself at this point in time. So it's not about shareholder value. It's about survival at this point in time that people need to be worried about.
So what does this mean in terms of an impact on their operations if no solution is found by November? I mean, do customers need to worry along with shareholders as well?
Oh, absolutely, Mangalam. I can tell you the kind of issues that customers have been facing, and personally I've experienced the kind of wrong international roaming charges that they levy, the kind of disputes that people keep on trying to address. The grievances are more related to billings, which have never been the case in all these years. It's a desperation that's kind of coming to show that the company is finding it difficult to manage its day-to-day business. The cash flows are getting so stressed out. So November is almost like around the corner, and if they are not able to resolve this, and if Indus decides to pull the plug, which at some point they will have to for their own business exigencies, it's going to be a very tricky situation. Except for a bailout, I don't see any other way out, and you really can't buy into something just hoping for a bailout. Bailout is the last thing that you could anticipate. So that hope trade is getting a bit stretched for shareholders and for consumers. Probably, you'll have to start looking at what MNP offers you at this point in time.
Okay, so, Vodafone Idea has been unable to raise funds. What if it doesn't fructify? Like that continues to be the biggest issue, even for the shareholders.
So, I don't think that is anything new. I mean, that was something which was expected. We also heard about, some debt restructuring where the government would kind of convert debt into equity. That's not happened. I don't know whether it's an issue related to pricing levels or, some sort of an understanding of timelines. But if they were to be able to raise money, and if it's not too enough, it's going to be too little, too late. So that's going to kind of push the can down the road, but it's not going to solve the problems. You just imagine the situation next year when 5G rollout is kind of full steam ahead with the other two players. Can Vodafone survive as the third respectable player of sorts with only 4G being offered? Which works like 2G for that matter, actually. So it's a very difficult situation from a business experience perspective rather than anything else. So I think the capital raise is overdue, and I hope it happens for the sake of the industry and sake of the consumers. But it seems very difficult at this point in time. Yeah.
All right, Prakash, thank you very much for joining us. Quick perspective there on an important subject. Thank you indeed. Well, the market is also sort of chugging along, but some would say, most would say in the wrong direction. It's down to being up 70 points. So for the period that we've been on trading hour, it's I think a low point in the last 30 minutes and low point of the day also. So this is at about 16,933 now. Rahul Mohinder is with us of VeraTechIndia.com. Rahul, good to have you with us here. Thank you very much. So is this a tradable kind of a move that you're seeing? It would be crazy to imagine if we didn't get the overnight bounce, right? I mean, for example, in the US, it sold off a little, some more after the kind of close that we had yesterday with the expiry, etc. It could have been a wild session. So far, it's okay. I mean, we were up 150. We've given up 50% of those gains. And it's a reasonable looking screen. But is this tradable now?
Good morning. I think, first of all, from a US market standpoint, I think the indices still look negative there. So if you're trying to take a bit of a global peep over there on the charts, it still looks like we're not out of the woods, and anything that you're seeing is got to be termed as some kind of a profit booking or a relief rally, if I may put it that way. And we're yet to really see a breakout. Even on the Nifty spot, what are the key levels one has to keep in mind just from a slightly broader picture, not just a today perspective? And I think that number is around 16,800. We start getting below that, I think we're going to again push off 4 or 5% of the index. So I think a largish down move can only come once 16,800 breaks. So I think if you're attempting to go long for a bit of a relief rally, one has to keep in mind that somewhere around 16,800, one has to keep a stop if you're attempting this. So one is being a bit aggressive. I'm not saying we're not at a support point, but at the same time, we don't have a signal of a breakout. So even today's opening couldn't even sustain, 17,000 for a couple of minutes. So really, we are yet to get that breakout. If I'm just looking at an intraday perspective, we still need to get above 16,980 to get a reasonable rally for the day. So in my opinion, we still look sideways to negative, 16,800 being the key level in mind.
I think the culprit has been the IT pack as well as the Nifty Bank as we speak. The IT pack has been the first one to move into the red. So the IT index actually should come up for you. There it is at the low point. And the other one is the Nifty Bank, which is still holding up in the green. But we have some large components which have moved into the red. Case in point, something like Kotak Mahindra Bank, which is currently at the low point of trade with a cut of almost 0.5%, but from the highs it's corrected about 2.5%. Axis Bank too, which is just about in the green by about 3 odd rupees, but that too has slid about 1.5% from the highs. Individual stocks, what's on your list this morning?
IT, as you started with, that looks like the weakest set. So I've got to sell on TCS, keep a stop loss at 3,045. I think we should slide to about 29.80 if you're looking at an intraday target. If you can hold through, we could even test 29.40. So that would be a sell. On the buy side, I still think something like a Hind Unilever offers a bit of a safe space. Keep a 26.80 stop loss and buy the dips. We could see 2,800 in a couple of sessions, may not be just a today trade. And Reliance, I think, is going to be the big trump card. You've got to watch a level of 23.20 on Reliance. If for any reason that level breaks, I think it's worth going short for targets, much lower. We're looking at about 22.90 coming in below 23.20. And thereafter, I think we can slide all the way down to 2140 as well. So keep 2320 in mind on Reliance. An aggressive trader would say, why not buy now with a small stop loss and reverse at 2320? And I wouldn't suggest that at this point, because we are yet to see a bit of a breakout on the stock. So I'm going to watch these levels, but I think clearly looks a bit negative to me.
Okay, all right, Rahul, thanks a lot for taking us through your technical picks. That's all about technicals of the markets, but now we'll slip into a short break and talk about a company. JSPL has cleared entire overseas debt. We'll speak to the CFO, Ram Kumar Ramaswamy, on the other side. Stay tuned.
Welcome back. A couple of mid-caps are actually doing quite well. We have Escorts, Kubota. Remember, this year has been quite a year for the stock. It's up almost, 42% in the last 12 months or so. But in recent past itself, we've seen a big move on Escorts. Crompton is the other one, and Voltas is the other one, which is spiking from the lows of today's trading session. So mid-caps generally are outperforming the frontline indices. But one of the stocks on our radar is JSPL. After the company has cleared its overseas debt repayment. They've repaid almost $1.8 billion, which were due in over the last 4 years. To discuss this and more, we are joined by the JSPL CFO, Ram Kumar Ramaswamy. Ram, thank you for joining in. You had promised to be debt-free by September 2022 back in our last conversation. Just wanted to understand that with this payment, are you entirely debt-free? What does the consolidated debt on your books stand at, if at all, if there is any?
Yes, thank you, and good morning to you as well. We had around $1.8 billion of overseas debt. We have brought that down to almost zero. As far as the domestic debt is concerned, the last quarter, we had reported a net debt of around 7,700 crores. Our journey of deleveraging will continue. As we have stated, we would like to be very, very conservative in terms of our debt and operate at a gearing of less than 1.5x through the cycles. So I think this will be an ongoing journey as we speak.
Okay, so currently your domestic debt is around 7,000 crore rupees. That is as on Q2, or that is the Q1 number?
That was the Q1 number, 7,700 crores.
So what is the outlook on your domestic debt now?
As I said, we are on a continuous journey of deleveraging. I will not be able to share very specific numbers, but that's the journey that we're on.
So this is rupee debt, right, Ram?
The rupee debt, that's right.
There's no dollar debt now?
That's right.
No dollar debt, $0 debt.
That's right. All our overseas debt we've fully paid off now.
Okay. And okay, I was just getting to the foreign exchange part of it. A large dollar debt usually at times like this causes a fair bit of pain, but that's not a problem in your case now.
Yes.
Ram, but in terms of any timeline or overall guidance on what you plan to do with the local debt or earlier repayment, would you like to leave us with something, a broad ballpark idea?
See, I think what I would like to restate is we would like to be very, very conservative from a debt perspective, and we want to operate at less than 1.5x through the cycles. Yeah. I think that's the journey that we will be on as we speak. There aren't any specific timelines or guidances that I would like to share at this point of time.
Right. We take that point. Just wanted to understand that with the debt that you've repaid right now, the overseas debt, etc., and you want to be conservative, as you pointed out, you had a massive capex plan as well going forward. I just wanted to understand, how will that be funded? That's point number one. And secondly, with the correction that we've seen in steel prices, are you looking to push that capex plan forward, maybe postpone it for now?
Sure. The entire capex is being incurred in our wholly owned subsidiary, Jindal Steel Orissa. Yeah. The current we are of course going to be funding it through a mix of debt and internal accruals. As we speak now, our priority is to ensure that we complete these projects on time and within budget. Yeah. And we will, of course, be constantly watching the horizon in terms of our overall gearing at Jindal Steel and also at a consolidated level to make sure that we operate on a very, very conservative basis.
So what would your capex amount be? And since we are talking about you continuing with those capex plans, will you be taking more debt in the domestic market?
As I said, that capex is being incurred in a wholly owned subsidiary, Jindal Steel Orissa. And that's going to be funded through a mix of internal accruals and long-term debt as well. We have already signed up for long-term debt for this with some of very reputed banks.
If you can give us that amount, Mr. Ramaswamy, what is the amount for the debt? We're just trying to figure out what would your debt number look like.
Sure. I think the term sheets that we had signed up for was close to around 15,000 crores.
15,000 crore of debt being in your wholly owned subsidiary would still mean that on a consolidated basis, you will have debt on your books, right?
Of course. Jindal Steel and Power, as a listed company, will be moving towards a continuous journey of deleveraging. And the capex plans will be through Jindal Steel Orissa, where we will have this 15,000 crore of debt as we speak. Yeah, that's right. Which we've signed up for.
Be that as it may, wanted to understand that now that you've cleared the debt of your overseas assets, etc., is there any way you're also looking to clear some of those overseas assets themselves, maybe get some more liquidity out for yourself, maybe some of the assets on the block?
See, I think we will be constantly evaluating options and opportunities in terms of capital allocation. And as we speak, there are opportunities that we continue to evaluate. If we think there is a good opportunity which is going to be value accretive, then we will definitely look at those options.
Could you be a little more specific, Ram? I mean, what are these opportunities, which geographies?
See, I would not be able to share more specific details on this at this point of time.
Okay. Ram, just give us an idea, again, very broadly without getting into numbers or anything. What will net realizations, or rather what have net realizations in the second quarter been like? I mean, the expectation out there is that compared to the first quarter, they'll be about 8 to 10% lower. So what is that number broadly going to look like? Are these estimates correct in the ballpark? And will this quarter also mark some sort of a low there in terms of realizations? And things are looking up Q3 onwards. What's the expectation? Yeah.
Second, I have to be very, very careful in some of these numbers.
Sure.
Because I think we are nearing our quarter end. I think what I can definitely tell you is our overall realizations during the quarter have been lower than the last quarter. This is, of course, available in the public domain in terms of the entire industry itself. So I think our story is also pretty similar to that. Yeah. But I can't give you very, very specific numbers. I think the outlook is definitely improving. That much again I can say. But you will have to pardon me for not being more specific on this.
Outlook in terms of pricing has improved, or demand scenario has improved?
Demand scenario is also looking strong. Pricing is also looking up over what it was over the last few months. Yeah.
Okay. Mr. Ramaswamy, I wanted to understand if you've heard anything on export duty, the removal. Is there any expectation from the industry? It's an industry-wide question, so no numbers here clearly. What are you hearing here?
I think we are all hearing the same news that is there in the public domain. I don't have any other internal news. We are also looking at this very, very closely to see how this plays out. Of course, with the export duty going out, I mean, whenever it does, I think the entire export opportunity that is available for us will once again, we will be able to really realize the benefits of that. Yeah.
Right.
So,
we are also watching this space very, very closely.
Okay, so we'll be watching that space closely. And just you said qualitatively the second quarter realizations were lower than the first quarter. Would you be able to tell us, was it 5%, 6%, 7%, 10%, a little more? I mean, just a ballpark range if you must. Not particularly for you, but for the industry.
Sure. See, I think again, given that we are almost on the verge of quarter close, it will not be fair for me to give any more specific numbers at this point in time.
And EBITDA per ton, will that be lower than the first quarter?
Again, I'll give you a sense of what it is. Our realizations have been are of course lower. Our costs, most of our raw materials are bought 3 months ahead, right? Our coking coal, etc. So we would be sitting on slightly higher cost raw materials, and therefore our EBITDA per ton would be lower this quarter versus the last one. Yeah,
right.
But I can't give any more specific numbers.
No, we don't want you to be specific at all. But thank you so much for taking out the time, being with us here on the program. Really appreciate it, and congratulations on that winding down of the Australian debt. And look forward to speaking with you again at the end of the quarter. Thank you indeed. All right, we'll take a quick commercial break here, and we'll come back. We'll focus on the chemical space when we come back on the other side. The market, by the way, has given up a little bit more. It's up just 65 points now, 16,922. So chemicals is the sort of topic next on radar in just a bit.
Hi, welcome back. You're still tuned into Trading Hour on CNBC-TV18. Well, the markets have fallen further. Bank Nifty in the red, down around 4 odd points. Nifty has come off the highs as well. It's up 45 points and at the day's low. So there's a sharp fall that we are witnessing right now, and it is led by the banking index. We have Kotak Mahindra Bank, which has fallen from the highs, and a couple of these banking names are at the lows, led by HDFC Bank. So that is a heavyweight, which is pulling the Nifty lower. So keep an eye out on that. The rally that we saw is not sustaining, and also the expiry day. So we'll have to see where the market moves from here. But let's talk about the broader markets. As we have been pointing out, that the chemical space is doing really well, and one of the stocks from the broader markets is Chemcon Specialty. It is up 9% on the back of some news flow. They have commenced commercial production of P9 unit at Gujarat, and that is where they will be launching a new product called bromobenzene, which is a solvent in use in motor oil additives as well. The capacity addition is 2,400 metric tons per annum at this P9 unit, and the company says that this will help them get into newer products and also help cater higher demand that they are getting for this particular bromobenzene segment, and customers are asking for more volumes here. Just to give you a perspective, Chemcon Specialty is into manufacturing and sale of pharmaceutical chemicals and oil well completion chemicals as well. So it is one of the biggest producers of HMDS, which is hexamethyldiazolene, and that is used in semiconductor coating, and also the largest manufacturer of CMIC in India and second in the world. So this opportunity definitely is something that the street is liking, and that's why so much excitement on this one. Okay, with that, we'll slip into a short break. Here's some great news for investors. You can now track US market actions real time on Money Control. Log on to Money Control website or app and stay informed about all that matters in global markets.
Okay, as we come to the fag end of the program, the show, the market's absolutely now flat. I mean, just 30 points left on the index. When we started, we had about 80, 85 on the Nifty. So it's just been one way south through the course of the last 60 minutes or so. We'll sort of come back and tell you stocks which are moving around, but basically everything has come off quite a bit. What was higher is up a little less. What was down is down a little bit more. Well, as we wrap up this show, let's get you some important opinion. Now, currencies have been the focal point for many. They've been in focus through the course of this week specifically, the rupee, the pound, etc. My colleague Lada Venkatesh spoke with former Reserve Bank of India Governor D. Subbarao on the rupee here, whether it continues to remain vulnerable and the road ahead for the economy. Listen in.
Well, without going into any quantitative measure of vulnerability, what is certain is that the rupee is under pressure. It depreciated by about 10% in the last 1 year.
Yes.
It's crossed the psychological barrier of 80 to a dollar. And foreign exchange reserves have come down by $100 billion from this time last year. We know that that pressure is coming because of two reasons. Mm-hmm. First, the current account deficit has widened, largely because of the increase in oil prices. Second, because of capital outflows triggered, importantly, by the financial tightening around the world, most importantly, the hike in interest rates by the US Federal Reserve. Now, it is certainly a cause for worry, but like you referred to the previous crisis, it's certainly not 2013, the taper tantrums. There's a big difference between the taper tantrums of 2013 and the situation today. For example, in 2013, the rupee was under pressure. There was a lot of pent-up exchange rate pressure in the rupee. It was overvalued, suddenly bled. This time, I think the rupee is tracking fundamentals more or less. Again, in 2013, we had the twin deficit problem, current fiscal account deficits year-on-year very high, leading up to the 2013 crisis. Today, this year, the current account deficit is expected to be high, but it's a one-off, hopefully. And on the fiscal, there's more credibility. And most importantly, we have the buffer of the foreign exchange reserves. So it's certainly not 2013. I would also say that it is less of a worry compared to what it was 6 months ago. If you compare to, let's say, March or April, oil prices come down to below $100. Our trade deficit, which was tracking about $30 billion per month, is now about, maybe it'll go down to $20, $22 per month on the average. So it's less of a worry, but I think if this situation persists, we will become vulnerable, and that will depend on a lot of global factors as well as domestic factors.
Okay. So, I agree. I mean, at the face of it, at that time, we were bracketed with the fragile five. Now, actually, people like Ruchir Sharma are bracketing us as the seven wonders, one of the seven, along with Vietnam, Indonesia, Saudi Arabia, etc. So, yes, we are actually in the upper echelon. But, if you dig the current account deficit a little more, the extent to which crude, the incremental pressure brought on by crude was only about $4 billion. So there are economists like Somanan Chakrabarti who pointed out on the channel that from 30 we may come down to 26, 27. We may not really come down $10 billion. Services, a lot of Indians have traveled abroad. A lot of students are studying abroad. So even if you count services, our current account deficit looks like will be well over $100 billion, which means 3.5% of GDP. And since only a small bit is crude, even if crude comes down, our imports are high. Don't you think this is a window of vulnerability?
Well, certainly. There should be no presumption at all that we're going to get into a comfort zone very soon. That's not going to be the case. The rupee is under pressure, will continue to be under pressure. Like you said, this year, the current account deficit is expected to be 3 or 3.5% of GDP. The RBI used to estimate that a safe level of current account deficit for India is 3% of GDP. That was during my time. I think they got more conservative now. Now they talk about 2.5% as being the safe limit. And note this, in the 6 years leading to the pandemic, we had current account deficit at the range of 1.4 to 1.5% of GDP, so in very safe limits.
Yeah.
So we're going to get into about 3%. As I said a short while ago, if this is a one-off, it's okay. But if it's going to persist, and if it's going to come on top of fiscal deficits, which are high, not just the central government, but both the center and states put together, fiscal deficits are still, I wouldn't say scarily high, but certainly quite high. That coupled with our current account deficit of over 3% of GDP certainly puts us in the vulnerable zone, and we're not going to get into a comfort zone anytime soon.